In the grand mechanism of the stock market, nothing is more crucial, yet more misunderstood, than the interplay of supply and demand. For the average man, the market appears as a chaotic whirlwind of rising and falling prices, governed by news, rumor, and sheer chance. He buys on hope and sells on fear, perpetually one step behind the true movements of the financial tide. But for the trained observer, the market is not a mystery. It is a logical entity that, through its own actions, consistently advertises its future intentions. The key to deciphering these intentions lies in one critical skill: the ability to recognize demand. It is the ability to see the subtle but deliberate footprints of smart money as it quietly prepares the ground for a significant advance. Richard D. Wyckoff dedicated his entire professional life to mastering this skill, and then to teaching it. He proved that predicting uptrends was not a matter of guesswork or inside information, but a science based on observable facts, logic, and a deep understanding of the market's fundamental laws. The foundation of his entire method rests upon the first and most simple of these laws, the law of supply and demand. This principle is as old as commerce itself, yet its application to the stock market was, and still is, largely ignored. Prices rise only when the force of demand is greater than the force of supply, and they decline when the reverse is true. When these two forces are in a state of equilibrium, prices move sideways within a narrow range. Every fluctuation, from the smallest eighth of a point wiggle to the grandest multi-year bull market, is a direct expression of this continuous battle. The thousands of influences that other people use as a basis for their actions, news, earnings reports, dividend rates, political events, and personal opinion, are all concentrated and boiled down into the combined effect of their buying and selling. This combined effect is all that matters, and it is all faithfully recorded on the tape, and by extension, on a price chart. Therefore, to predict a future uptrend is to accomplish one thing: to identify, through a logical analysis of price and volume, the point at which demand is quietly but decisively overpowering supply. This does not happen by accident. It is the result of a deliberate, well-planned campaign conducted by the most informed minds in the market, an entity Wyckoff termed the composite man. The primary evidence of this emergent demand is found in a market phase Wyckoff identified as accumulation. This is the first and most critical stage of any bull campaign. Accumulation is the process by which the composite man, the amalgamation of large operators, insiders, and skilled financial interests, absorbs the available floating supply of a stock from the public, or weak hands. This process is conducted with great skill and patience, often over weeks or months, and its primary objective is to acquire a large line of shares without causing the price to advance significantly. To do this, the composite man must operate under a cloak of pessimism. Accumulation almost always takes place after a prolonged and often punishing decline. It occurs at price levels where the news is at its worst, where corporate earnings are poor, and where the general public, discouraged and fearful, is finally capitulating and selling its holdings, often at a substantial loss. This environment of gloom is precisely what the composite man requires. He has the foresight to see a change in conditions far in the future, and he uses the current bearish sentiment to his advantage, willingly taking shares off the hands of those who can no longer bear the pain of holding them. The entire process is a transfer of ownership from weak, emotional, and uninformed hands to strong, patient, and highly informed hands. Recognizing the distinct phases and characteristics of this accumulation is the key to predicting the subsequent uptrend. The first sign that a long decline may be ending and that accumulation may be starting often appears as a dramatic and violent event on the chart. Wyckoff identified two key markers: preliminary support, PS, and the selling climax, SC. After a stock has been trending down for a considerable time, there will come a point where the first significant buying appears. This preliminary support is often characterized by a noticeable increase in volume and a widening of the price spread after a long downward march. It is a signal that the first wave of bargain hunters and informed interests are beginning to step in, but it is usually not strong enough to stop the decline entirely. The downward move often continues and the public's fear intensifies, culminating in a selling climax. This is the event where the stock experiences a precipitous drop, a rapid acceleration of the decline. On the chart, it appears as a day or a series of days with an enormous price range, where the stock opens high and then plunges to a new low on exceptionally heavy climactic volume. This is the moment of capitulation. The last of the weak holders, unable to withstand the pressure any longer, throw their shares onto the market in a panic. It is precisely this deluge of supply that the composite man has been waiting for. He steps in and absorbs these shares, his immense buying power meeting the public's panicked selling. The very high volume is a characteristic symptom of the climax, as both supply and demand must expand sharply under these conditions. But now, the supply is of poor quality, panicked, while the demand is of good quality, informed. The action of the price itself provides the final clue. After plunging to its low point, the stock often closes well off the bottom for the day, demonstrating that the immense selling pressure was met and completely absorbed by an even greater buying power. This climax exhausts the selling force, and a technical rally, which Wyckoff called the automatic rally AR, almost invariably follows. The high point of this automatic rally helps to establish the upper boundary of the A trading range, TR, while the low of the selling climax establishes the lower boundary. The stock has now entered a new phase. The downtrend has been arrested, and the battlefield has been defined. The war between supply and demand will now be fought within the confines of this trading range. And it is here that the careful student of the Wyckoff method can find the most definitive clues of a coming uptrend. Once the trading range is established, the process of accumulation begins in earnest. The stock price will oscillate between the support level defined by the selling climax and the resistance level defined by the automatic rally. This sideways movement, which can last for months, is the cause being built for the future effect of a sustained advance. To the uninformed observer, this period appears as a lifeless, uninteresting market. But to the Wyckoff analyst, it is the most critical area of study. The primary objective during this phase is to determine whether the dominant force within the range is supply or demand. If it is demand, then accumulation is taking place. If it is supply, then the stock is undergoing redistribution and another decline is likely. Wyckoff provided a series of tests to make this determination, based on a meticulous analysis of price and volume. The most telling sign is the character of the volume on movements within the range. During a genuine accumulation, volume should be pronounced on rallies up from the bottom of the range and should noticeably diminish on reactions back down to the support level. The shrinking volume on declines is of paramount importance. It indicates that sellers are becoming scarce. The pressure is lifting. It shows that the composite man has been successful in mopping up the floating supply, and there is little stock left to be had at these low prices. Conversely, if volume expands on reactions and shrinks on rallies, it suggests that supply is still present and is coming to market on every advance, a bearish indication. Another critical test is the nature of the support. During a successful accumulation, the low points of the reactions within the trading range will tend to become higher over time. For example, after an initial low at $50, the stock might rally, then react only to $50.50, then rally again and react only to $51. This pattern of higher supports or higher lows is a powerful bullish signal. It indicates that the buyers are becoming more aggressive. They are no longer willing to wait for the price to return to the absolute bottom of the range to acquire shares. They are raising their bids, a clear sign of their eagerness to accumulate more stock. This subtle but persistent lifting of the supporting points shows that demand is overpowering supply within the trading range itself, long before any breakout occurs. This is one of the more reliable signs that the stock is being prepared for a significant markup. The Wyckoff analyst meticulously charts these movements, drawing trend lines along the rising bottoms to visualize the changing character of the market. The stock is building a solid foundation, a launch pad for its future ascent. The opposite, a pattern of lower tops on rallies within the range, would be a bearish indication, showing that sellers are becoming more aggressive and are willing to accept lower prices to distribute their stock. It is during this extended period of sideways movement that the composite man often employs his most skillful and deceptive maneuvers to complete his accumulation. The most famous of these is the spring or shakeout. A spring is a sharp and often brief price movement below the established support level of the trading range. Its purpose is threefold. First, it is designed to mislead the public and the uninformed chart watchers. The break below a clear support line is almost universally interpreted as a sign of renewed weakness, prompting many to sell their long positions or even initiate new short sales. Second, it allows the composite man to hunt for stop-loss orders, which are typically clustered just below the support level. By driving the price down just far enough to trigger these stops, he can force other traders out of their positions and acquire their shares at artificially low prices. Third, it serves as a final definitive test of supply. If there is still a significant amount of stock left to be sold by weak hands, the break below support will trigger a cascade of selling, and the price will continue to decline. However, if the accumulation has been successful and the floating supply is scarce, the break below support will not be met with significant follow-through selling. Volume on the break may be high, but it will quickly diminish. The key to identifying a maneuver as a true spring is the price action that immediately follows the break. A genuine spring is characterized by a rapid recovery, where the price quickly reverses and climbs back into the trading range. It does not linger in the low ground. This quick reversal on low volume is one of the most powerful buying signals in the Wyckoff methodology. It is a sign that the last of the sellers have been shaken out, the track is now clear of supply, and the stock is on the springboard ready for an advance. The accumulation of all these insights requires patience, diligence, and a commitment to the process of learning. The principles laid out by Wyckoff are not shortcuts, but a complete method for logical deduction. It is the work of a financial detective, piecing together clues from the tape to form a coherent picture of the market's true state. And it is at this point in our journey together, as we move from the foundational principles to the more nuanced applications, that it seems appropriate to pause and reflect. The work of analyzing these charts, of training one's mind to see the subtle story of supply and demand, is demanding. If you find this detailed, logical approach to the market to be of value, if it begins to illuminate a path away from the guesswork and emotional trading that plagues so many, then I would ask you to consider taking a moment to support this channel. Please take a second to like this video and subscribe for more in-depth analysis based on these timeless principles. More importantly, leave a comment below. Your feedback is invaluable. It helps this educational content reach a wider audience of aspiring traders and investors who are searching for a sound methodology. It also provides profound encouragement, letting me know that this work, this endeavor to share the science of the market, is not in vain. Your engagement truly helps build a community dedicated to the principles of intelligent speculation. Now, returning to our analysis, after a successful spring or after a final period of testing near the bottom of the trading range, the composite man has completed his accumulation. The stock is now in a technically strong position, held by informed interests who will not be easily shaken out. The path of least resistance is now upward. The final confirmation that the markup phase is beginning is an event Wyckoff colorfully named the Jump Across the Creek, JAC. The creek is the line of resistance that forms the upper boundary of the trading range. A jump across the creek is a decisive, powerful move by the price out of and above this resistance line. This is not a timid or hesitant move. A genuine JAC is characterized by a notable expansion in price spread and a significant increase in volume. This shows that demand is now fully in control and is strong enough to absorb any remaining supply that might appear from traders who had previously sold at those levels. This is the moment when the stock breaks free from its preparatory phase and begins its public advance. The tape reader, who has patiently watched the entire accumulation process unfold, is now given his clearest signal to act. While buying during a spring offers the greatest potential reward, it also carries the risk of misinterpreting the move. The jump across the creek, however, is a confirmatory signal. It is the market's announcement that the period of quiet preparation is over and the public markup is underway. Often, after this initial jump, there is a small pullback or sideways movement, which Wyckoff called the back up to the edge of the creek, BU. This is a final, smaller test of supply before the main advance gets underway. This pullback should occur on diminished volume, once again confirming that supply has been exhausted. This last point of support offers a final, excellent opportunity to initiate or add to a long position with a clearly defined stop-loss point just below the newly established support. In summary, recognizing demand and predicting an uptrend according to the Wyckoff method is not a matter of finding a single magic indicator. It is the work of a financial detective, a process of observing a logical sequence of events and weighing the evidence as it appears on the chart. It begins with identifying the cessation of a downtrend through preliminary support and a selling climax. It continues with a careful analysis of the subsequent trading range, looking for the telltale signs of accumulation, diminishing volume on reactions, the appearance of higher supports, and the telltale manipulative shakeouts or springs designed to remove the last of the weak holders. Finally, it requires the patience to wait for a definitive confirmation, the jump across the creek, which signals that the stock is ready to begin its true advance. Each phase provides clues, and the weight of the evidence, gathered over weeks or months, builds a logical case. This is how the Wyckoff student learns to anticipate major uptrends. He does not guess or gamble. He observes the evidence of a campaign being conducted by the market's most informed players, and when the time is right, he places his capital in harmony with the force of their demand. He learns to buy not with the crowd at the top, but with the composite man in the quiet moments of preparation at the bottom. While this video provides the essential framework for understanding the principles of accumulation, the detailed examples and the personal narrative that solidified these concepts in Wyckoff's own mind are timeless. He meticulously documented his own journey, his mistakes, and his triumphs in his writings. For those who wish to truly master the lessons we discuss, to see them applied through the eyes of the man who developed them, a new, unique edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, has been carefully prepared by Max Davidson. This work has been thoughtfully adapted for the modern trader, with clear explanations and annotations that bridge the gap between Wyckoff's era and today's markets. It is not just a reprint. It is a vital educational tool. For anyone serious about making the Wyckoff method a core part of their own trading, this adapted edition is an indispensable resource for your library. The link to this essential book can be found in the description of this video. The principles of recognizing demand are not relics of a bygone era. They are as relevant today as they were a century ago, because they are not based on technology or market fashion, but on the one constant in all markets, human psychology. The dance of hope and fear, greed and panic, which drives the buying and selling of the public, remains unchanged. And the logical, patient operations of the composite man who uses these emotions to his advantage are just as prevalent. By learning to read the chart through the lens of the Wyckoff method, one learns to see the market not as a series of random price wiggles, but as a clear, unfolding story. It is the story of supply and demand, of preparation and execution, of cause and effect. Mastering this story provides the ultimate advantage, an edge that comes not from secret information, but from superior knowledge and a disciplined, scientific approach to the greatest game in the world.